Inflation is described as small and manageable. It is framed as normal economic growth. So why does something called healthy quietly make life more expensive every year? Most people think inflation simply means rising prices. Gas costs more, groceries cost more, rent increases. The explanation sounds straightforward. Demand rises faster than supply. Production costs increase. Businesses adjust prices. Inflation is presented as temporary, a reaction to shocks, a cycle that stabilizes. News coverage reinforces this framing. A percentage appears on screen. 2%, 3%. Those numbers feel modest. Inflation is discussed like weather. It moves up, it moves down, it is monitored. Central banks aim for a target rate. Governments speak about controlling it. The language is technical and calm. This makes inflation feel contained. It feels like a short-term imbalance, not a long-term shift. Because the explanation is repeated often, it becomes accepted. Inflation equals price increases. Price increases equal market adjustment. Simple. Inflation is not only about prices rising, it is about purchasing power falling. That difference is critical. When inflation is reported at 2 or 3%, it reflects an average basket of goods, a model household. But real households do not spend according to averages. Housing, healthcare, and insurance often rise faster than official rates. At the same time, wages do not adjust continuously. Prices change immediately. Income changes periodically. This structural delay matters. Central banks expand or contract money supply through interest rates and credit conditions. Over time, money supply tends to grow. More currency in circulation reduces the value of each unit gradually. A small annual rate compounds. 2% per year does not feel dramatic. Over 20 years, it changes purchasing power significantly. Debt operates differently under inflation. When currency weakens slowly, the real value of long-term debt declines. Governments carry large debt loads. Corporations borrow at scale. Moderate inflation reduces the real burden of that debt over time. This is not a mistake. It is embedded in the system. Businesses with pricing power can adjust prices quickly. Employees renegotiate wages occasionally. That gap creates predictable pressure. Expenses move first. Income moves later. Across millions of households, the pattern repeats. Inflation is not just a temporary spike. It is a long-term currency dynamic that steadily shifts cost structures. But because it happens gradually, it feels disconnected from the system that produces it. Inflation works through small increments. A subscription rises by $1. Insurance increases slightly. Groceries edge higher. Each change feels manageable. Humans struggle with compounding effects. A small annual loss of purchasing power does not trigger alarm. It feels minor. Over time, adaptation replaces resistance. Spending habits adjust, quality shifts, expectations reset. When wages increase, even slightly, it feels like progress. But if prices rise at the same pace, real purchasing power remains flat. Because inflation is described in percentages rather than lived cost, it feels abstract. It does not feel systemic. It feels personal. Life simply becomes more expensive. Gradual change normalizes quickly, and normalization shapes understanding. Inflation does not affect all participants equally. Those who hold large amounts of cash lose purchasing power first. Those who hold assets often see nominal values rise. Real estate prices adjust upward over time. Stocks reflect higher revenue numbers. Hard assets reprice with currency shifts. Financial institutions operate inside this structure. Banks lend money created through credit expansion. Loans are repaid in future dollars. If inflation persists, those dollars are worth less in real terms. At the same time, banks earn interest on nominal balances. Governments also function within this dynamic. Public debt is issued in currency. If that currency gradually weakens, the real weight of existing debt declines. Tax systems are rarely indexed perfectly. When wages rise in nominal terms, tax brackets can pull households into higher effective rates, even if real purchasing power has not meaningfully improved. This phenomenon increases revenue without explicit tax increases. Corporations with pricing power adjust faster than labor markets. Large firms can pass higher input costs to consumers. Smaller firms and wage earners adjust more slowly. Inflation therefore redistributes quietly, from cash holders to asset holders, from fixed income earners to variable revenue systems, from savers in currency to owners of appreciating assets. None of this requires coordination. It is a structural outcome of monetary design. Inflation smooths over debt loads. It supports asset markets. It reduces the real burden of long-term obligations. The system benefits from controlled, steady inflation because it maintains momentum. Zero inflation would freeze pricing flexibility. Deflation would increase real debt burdens. Moderate inflation keeps the machinery moving. Predictability is key. Small, consistent erosion feels manageable. Large shocks create instability. So the preference is gradual movement, and gradual movement is rarely perceived as a structural transfer. Inflation is embedded in language. Prices are said to go up. Costs are described as rising. Wages are said to increase. The focus is on motion, not on purchasing power. Because the change is incremental, each year feels similar to the last. 5% feels tolerable. 3% feels mild. Compounded over decades, it transforms cost structures entirely. But decades are abstract. Monthly bills are concrete. People anchor expectations to current prices quickly. What once felt expensive becomes standard. A gallon of milk, a tank of gas, a home price, all reset psychologically. Older reference points fade. News discussions concentrate on whether inflation is accelerating or slowing. Rarely is the baseline itself questioned. If inflation drops from 8% to 3%, it is described as improvement. Yet prices remain higher than before. The narrative focuses on the rate of change, not on accumulated impact. Over time, the constant presence of inflation turns it into background noise. It becomes assumed. Savings accounts rarely keep pace. Interest rates fluctuate. Asset markets swing. But the steady erosion of currency value continues quietly. Because it is gradual, it feels natural. Because it is universal, it feels unavoidable. Normalization removes urgency. And once something feels normal, it stops being examined. Inflation is often described as rising prices. In practice, it is a long-term adjustment in the value of money itself. It reshapes purchasing power slowly. It redistributes through timing. It compounds through small percentages. The misunderstanding persists because the effects are delayed, averaged, and abstracted. Prices are visible. Currency erosion is not. This does not mean people are careless. It means they are navigating a monetary system designed around gradual change. And gradual change is the hardest kind to recognize.